Hi, dreamers. It's tax season, so many of you have asked me about my taxes, given that my dividends are approaching $100,000. So today I'll give you a peek at what it's like in terms of taxes and also cover some common questions I get. One reason why I love dividends is how tax advantaged they are. But before we dive in, I just want to remind you that I'm not a tax advisor. And based on your individual situation, it could vary quite a bit. So please remember that and see your own tax consultant for individual help. Okay, come on, I'll show you what I know, which will be enough for you to grasp the basics. All right. As you know, the market goes up and down, but roughly I have $1.5 million in my portfolio. And if you break that down by different kinds of accounts, essentially I have about 50-50 in retirement accounts and taxable accounts. So right off the bat, any dividend that I receive inside of my retirement account means that I pay no taxes. No matter what the dividend is, I am going to pay 0 taxes on those dividends until I withdraw in the year for the year. So if you have your entire portfolio inside of retirement accounts with dividends generating, you're not going to pay any taxes whatsoever. So let's get to the taxable account. So in 2022, roughly, I made about $41,000 in dividends off of my taxable accounts. So let's take a look at those taxes. Well, of the $41,000, $38,000 was qualified dividends. And so I paid $5,700 in taxes off of those dividends, which is a 15% tax. Now, before we go any farther, let's talk about that 15% tax and the different tax brackets, and also what is a qualified dividend. So here are the tax rates for qualified dividends. And up at the top, you can see the chart for 2022. And at the bottom, you can see the chart for 2023. And take a look at the changes from 2022 to 2023, because they were pretty big changes. So focusing in on the year of 2022, since that's what we're talking about, in terms of last year, if you are single and you made less than $41,675 total in income, you would pay 0% tax on your dividends. If you were married filing jointly and made less than $83,350, you would have also paid 0% in your tax rate. Now, as you saw, I paid the 15% tax rate. And so I'm married and I filed jointly, and I fell into this box right here. And as you recall, I didn't work very much in 2022 because I took half of the year as a sabbatical. So we definitely fell underneath that $500,000 mark. Now, let's say that you're a high earner and you as a household earn more than, say, $518,000. Your max tax rate is going to be 20% on those dividends. And although that may seem like a lot, consider your normal ordinary income tax rate of 35%. So the tax rate in dividends is much more advantageous than ordinary income. Now, let's take a look at the bottom to see where those ranges net out for 2023. And you can see a really nice increase to $44,625 for single, $89,250 for married filing jointly. And you'll need to make more than $550,000 married filing jointly to get to that 20% tax rate. So the majority of people will find themselves in this 15% tax rate. Although, I just want to point out one more thing. Imagine that dividends are the only thing that you have coming in as income. And just imagine that you're making $90,000 in dividend income, and that's it. What that would mean, if all were qualified, is that you would pay 0% in taxes. And that, my friends, is one of the wonders of dividend investing. So let's make sure for a second that we're all on the same page in terms of what is a qualified dividend, since all of these rates are just about qualified dividends. So overall, a dividend is a portion of a company's earnings paid directly to shareholders. Companies that offer dividends pay a fixed amount per share and can adjust it up or down with each earnings period, as you know. The qualified dividend criteria is that the investor must own them for at least 60 days out of a 121-day holding period. And so, in a nutshell, that's the basic definition of qualified dividends. They don't want you buying a stock and selling and buying and selling and buying that stock. They want you to hold the stock. And so they're giving you an incentive to hold it for at least 60 days. Okay, so now that we're all on the same page in terms of those qualified dividends and the 15% taxes that I paid on the $38,000 of the $41,000 within my taxable account, the remainder of what I paid was on ordinary dividends, which was taxed at a higher rate of 22%. So overall, I do a pretty good job making sure that the kinds of stocks that I hold in my taxable accounts are primarily going to be qualified dividends. But what kinds of things become ordinary dividends? Well, one common question I get is, how are ETFs taxed? And the answer is, it depends. Because if you have a dividend ETF, it may be taxed the same as individual dividends. But if you have a REIT ETF, those REIT ETFs are generally considered unqualified, which means they're taxed as ordinary income. And so you could be taxed up to that 35 or 37% income level, depending on your income threshold. What about other kinds of stocks? So let's stay on the topic of ETFs for the first part of this. Did you know that something like JEPI or JEPQ has 80 to 85% of their dividends taxed as ordinary income? So that is something to consider even with that high yield. And part of that is because of how they're actually generating that income. A big part of it is through equity-linked notes. So when you're picking an ETF, you want to look at how it's actually paying out. And one way I like to do this is actually inside of your brokerage account. So let me show you an example of that. So here's an example of BDJ, BlackRock Enhanced Equity Dividend Trust, and this is one that I hold. If you go to the Distributions and Expenses tab and you start to scroll down, you'll see this little area right here, Dividends Distribution Types. And then in this box, you can visually see that the green are dividends, the orange is long-term capital gain, the yellow is short-term capital gain, and then the purple, which there isn't any here, is return of capital. And so I'm not going to get into short-term capital gains and long-term capital gains and all of the different tax structures on those things, but I just wanted to show you how it looks when there's different taxes being applied based on the distribution type. What I'm talking about in this video is the tax structure around the green section, dividends. Let me show you what this looks like for something like SCHD. So here we are in SCHD, and under the Distributions and Expenses tab, you can go down, and there you are. You can see that the distributions type is all dividends, and no types of return on capital or capital gains. Let's check out Devo, one of my other favorite ETFs, as you know. And so here's Devo, and as we scroll down under this tab, you can also see all dividends for Devo. And this is one of the reasons why I like Devo so much and hold it in my taxable accounts. Okay, so if that's ETFs, and now you guys know how to use your brokerage account to type your symbol in and just take a look and get a good sense of if it's something that you want to hold in your taxable account or if you want to hold it more in your retirement account. Like, for example, I hold BDJ in my retirement account, and I hold Devo in my taxable. Let's talk about REITs for a second. So in this article from TurboTax, and there's many different articles, they talk about the two types of REITs, equity and mortgage, but it really doesn't matter which type of REIT you're talking about. For the most part, payments from REITs are referred to as dividends, but they're really not dividends the way we've been just talking about it. It's primarily made up of ordinary income made from collecting rent, capital gains made from selling the property, or return of capital, which is essentially the REIT giving you some of your own money back. And so because this is the makeup of what they call the dividend, typically it's best to hold a REIT in your retirement account because they are going to be taxed at an ordinary income level. Now, what about something like a BDC? BDCs also can be structured wildly differently. They have income, which is money earned from fees and interest. generally earned on loans, preferred stocks, things like that. Non-qualified dividends, they also may have qualified dividends, which would be paid to the BDC from common stock, and then return on capital, which is just like the REITs, pretty much your money coming back to you. And so this is a nice example right here in this box, where you can see the percentage of ordinary versus qualified dividends and how it's actually changed over time. For something like Maine, you can see in 2010, the vast majority, over 81%, was ordinary dividends. And in 2011, they had changed their structure enough to take that down to just under 74%. And by 2012, again changed their structure to take that down to about 53%. And so the point of me bringing this up is that when you have something like a BDC, the percentage of quote-unquote dividends that you will be taxed as ordinary versus qualified actually will depend on how they have structured their investments for the year in the year. And this is one reason why I'm not a huge fan of BDCs, because unless you're staying on top of this or management has made a definitive promise, these percentages could go up or down. And that just doesn't happen for individual stocks that simply remain 100% dividends the whole time. Okay, so those are examples of ordinary dividends. And I hold things like O Realty Income and some JEPQ. And I do hold some REITs, like ticker symbol O, that contribute to this line right here. And so my total taxes for 2022 was something in the neighborhood of $6,360. Now, I also paid some Canadian tax throughout the year, but there's a treaty between the US and Canada which waives all of that tax. And so you essentially get a credit for all of that back. So I paid it and I got it back, which doesn't really change the total tax. So that's the full look at my 2022 taxes and what it would look like for essentially half of my dividends. Now, the last thing I wanted to cover is a common question that I get, which is, how does the tax rate change if you're dripping your dividends? In other words, if you're automatically reinvesting those dividends right back into the stock that you're buying. And the answer is essentially right here, that sometimes we think that because we're reinvesting that we won't have to pay taxes on those dividends. But unfortunately, that is not the case. Whether you take those dividends as cash or you reinvest those dividends, you will still be taxed on those dividends inside of a taxable account in the year for the year. So that's just something to be aware of, that if you have dividend producing stock, you will be taxed on those dividends. All right, guys, I just want to remind you that there are so many other factors with taxes, and some people even set up C Corps or S Corps or other business structures that may also affect your taxes. So please consult a tax pro for what might be best for you. But I hope this has helped you get your footing with the basics. Well, that's it for today, and as always, I encourage you to do your own research, then implement and learn by putting it into practice. As a reminder, I'm not a financial advisor, so keep in mind these videos are for entertainment and inspiration only. I'll see you on the flip side.